Hello, I'm Stacy Francis, President and CEO of Francis Financial. As part of our ongoing commitment to your long-term financial success, our investment committee meets every single month for an in-depth review of each of your holdings, our investment philosophy, and review of that research process. As a best practice, we look at each investment decision by combining both our internal analysis as well as our insight from industry leading external research partners. In an effort to essentially give you a sneak peek behind the scenes, I wanted to talk to you this month about what we're looking at and share some recent developments from our most recent monthly investment committee meeting. We not only met internally, but we also met with numerous research partners outside of Francis Financial. Our biggest topic that we're looking at that we want to talk to you about is something that's all over the news, and that is interest rate and inflation risks. And I wanted to talk to you about what does this mean for your portfolio? What does this mean for you? Well, let's talk about interest rates first. Bond prices, the value of bonds, and interest rates, well, they have an inverse relationship. So that if we see interest rates rise, well, the prices of bonds tend to go down. Now, the Federal Reserve is poised to increase interest rates over this next couple of years. There's talking about this to curb high inflation. And so, because of this, we met with all of those mutual fund managers that we're working with at Putnam, BNY Mellon, Dimensional Fund Advisors, and more to dig into each of these holdings more to see if they can weather the storm of an unfavorable interest rate environment. The analysis that we created based on the portfolio information shows that you're actually in a good place. And let me talk about this. The first thing that we looked at is duration. I know that duration is a very technical term, but really it just means what is the measure? How long do you have to wait till that bond pays out its principal? So is it a 1-year bond where the principal pays back to you in 1 year? Or might it be a 20 year where you have to wait 20 years? That's essentially what duration is. And what we found is that bond prices react much more negatively when interest rates rise the longer the duration. So a bond that has a duration of, let's say, 20 years, if there's a 1% increase in interest rates, well, that bond price is going to go down much more significantly compared to a bond that maybe has a 1-year duration. So what does this mean for you? Well, your duration in your portfolio is a lot shorter than most. In fact, the typical benchmarks, the Lehman Bond Aggregate Bond Index, the duration is actually 7 years. And the duration for you is closer to about 5 years. This is, again, just one of the pieces that we have done to make sure that you're as protected as possible. Now, number two, active management. We believe that particularly in the bond area, active management is important. A active strategy in our bond exposure allows us to have a mix of different types of bonds and maturities and durations to reflect what's going on in the market, like what's going on now. And it helps anticipate interest rate increases and making changes to protect you against it. So that's number two. Number three, well, you have high quality bonds. We don't have junk bonds in your portfolio. And junk bonds, they're also known as high yield bonds. Junk bonds are exactly just that. They tend to move in the similar way as stocks move. So, in an environment like now where we're seeing stocks drop in value, well, junk bonds are dropping in value too. But that's not the situation with high quality bonds. In fact, high quality bonds and stocks tend to react in opposite directions. You could call it a negative correlation if you want to use that fancy cocktail speak, but essentially they're in opposite directions. So when stocks are taking a dive, those high quality bonds are actually maintaining their value, in many cases increasing their value as there's more demand and more people flock to the safety, the airbag of those high quality bonds. This is really important, especially as we go into an environment where we expect interest rate increases. With the Federal Reserve set to raise interest rates as many times as 4 times this year and potentially in 2023 and 2024, know that we're continuously monitoring the market conditions and your portfolio. We're confident in your allocation and know that we're here, though, for any questions. Keeping you informed is extremely important to us. So if you have questions, please don't hesitate to reach out. We're here for you.